We've built our reputation on saying yes to the right deals, not every deal. Our partners trust that when we commit, it's because we've done the work and believe in the long-term performance of the borrower.
Welcome back to ACS Portfolio Perspective. I'm your host, Andrew Pace, or as Hollis would say, Pache, Chief Client Experience Officer at ACS, joined today by Hollis Bufferd, Chief Executive Officer and Managing Member of Star Hill Financial. Hollis founded Star Hill in 2016 as a women business enterprise, creating innovation partnership models that help customers meet diversity, spend requirements while delivering practical financial solutions. Under Hollis's leadership, Star Hill has developed into a diversified lender with strengths in both equipment and franchise financing, a strategic expansion that demonstrates her ability to identify and capitalize on market opportunities. Before founding Star Hill, Hollis served as Chief Administrative Officer of GSG Financial from 2005 to 2017, where she was instrumental in building organizational culture and was part of the leadership team that successfully sold GSG to On Point Group, now NextGen, in 2016. Hollis is deeply committed to the equipment finance industry. She serves on the ELFA's board of directors and will chair LeasePack in 2026. She's also an active member of NEFA and serves on the Advisory Council for Equipment Finance Cares. Hollis holds a bachelor's degree from the University of Connecticut School of Business. Hollis, welcome to the show.
Thank you. Good to see you.
It's great seeing you too, and it's great to have you on. I think a perfect place to start is with that idea of adaptability, something that's been a defining theme for you and for so many in our industry over the past few years. During COVID-19, you made a major pivot from traditional equipment finance to franchise financing. What led to that decision, and how did you identify that opportunity while others were pulling back?
Our franchise into franchise was pretty much an opportunity surrounded by timing. Keith Smith, co-owner of Star Hill and my partner here, had prior experience in franchise financing. When he joined the company, we had a long-term plan of doing franchise eventually, but it was probably more down the path of like 23, 24. With COVID-19, there was so much uncertainty. Then you ran into supply chain issues. And then there was a slowdown in equipment originations. So Keith had observed that, quick service restaurants, well, a QSR, were thriving, mainly because, drive-throughs weren't disrupted necessarily by COVID. Everyone kind of switched to curbside pickup. And the model of a quick service was really aligning with, consumer behavior during that time. So we made the strategic decision to kind of advance our timeline of when we were going to get into franchise financing and started it in 2021.
So for independent lenders without the scale of big banks, what are some of the practical ways to recognize and act on emerging opportunities during those times of disruption?
We like to say here that where there's chaos, there's opportunity. And you really get that benefit as an independent, because we have the ability to pivot either into other asset classes, add different types of financing products, while being aware of the market shifts with interest rates, regulatory, bank pullbacks. One of the independents' reasons for success is we're able to move faster, be more flexible than other, financial institutions that are out there.
And when you think about diversification versus concentration, what frameworks or guiding principles have helped you make allocation decisions across your portfolio?
We evaluate multiple dimensions. We look at industry vertical, asset type, and we're very credit driven. We rely heavily on the team at Star Hill's experience to evaluate the risk. We like to say we're asset agnostic as long as the asset makes sense for a business model.
As someone personally guaranteed during the 22-23 banking crisis, what did that experience teach you about resilience, leadership, and managing through that uncertainty?
Yeah, that was a good one that came along. We realized, relying too heavily on a single banking partner, even one that you have a long, solid history with, was not necessarily the best model for us. So we took a step back during that time, focused on growing relationships with other funding sources, including banks, funding partners, and even some private capital channels. Our goal during that time was to try to be business as usual, even though we kind of stepped back and were more conservative in the deals we wanted to do on our line. And then we also had to look at, by personally guaranteeing the lines, it forces us, we have a personal risk in the company, not just, oh, it's the company, whatever. Keith and I are putting our names on everything. And it forces us to really collaborate and be better partners.
So that strategic agility clearly shaped how you built and scaled Star Hill. Let's shift gears and talk about your approach to building an independent finance company and what's made your model stand out. So you built your team around seasoned veterans, as you mentioned earlier, rather
Yeah.
than developing from entry level. What led to that decision and how has it impacted your growth?
We're small independent, so recognizing relationships, credit discipline, and deal structure, having that knowledge can make or break a transactions, and experience is our competitive edge. Our team members bring decades of expertise across, again, credit documentation, sales, and by being a small team with an experienced or seasoned group, we're able to move quickly, anticipate challenges, and come up with solutions that are pretty good for our customers, where a less experienced team would probably miss.
And you mentioned Keith earlier. Tell us about your partnership with him. How do your complementary strengths play off one another, and how has that partnership evolved over time?
Anytime you do a partnership, there's always the risk of it not working. We've been very fortunate that the partnership has really been a cornerstone of our success. My background was heavily in operations, IT, HR, software, documentation, process and systems, where Keith's experiences lied more in business development, the banking relationships, credit, and of course, his experience in franchise financing. So our partnership, really allowed us to kind of focus on where we had our own expertise and not necessarily be overlapping in how we wanted to accomplish success here. And it does help too that we very much have mutual respect. We share values, and which also leads us to, the ability to challenge each other because we see it from different perspectives. Again, I have an ops head. He is more credit banking. So it's interesting, but it works.
That's awesome. And there's always a balance, right, between staying small and nimble versus scaling aggressively. How have you approached that trade-off?
Um, Maintaining a lean team allows us to move quickly, make decisions real time, stay close to our customers. We don't have layers of bureaucracy slowing us down. Our customers get, to the top leadership and even company owners when needed without having to go through a process of, oh, I need a manager. I need this. I need that. Even to this day, um, I think I answer all incoming calls that come into Star Hill once they, bypass select your extension. Because if there's an issue, I want to know about it as an owner. And, Keith wants to know too. So we let it, in a sense, I become the operator if someone really needs to reach us. But the flip side of being nimble is resource constraint. We can't do everything at once. Scaling originations and sales, compliance, technology simultaneously takes careful organization. We have to be very disciplined about where we deploy our time, capital, and priorities. Larger institutions can absorb this by, they have teams. They may have, hundreds of employees or triple the amount that Star Hill has. And then we also can run into capacity risk. When business surges, again, a very good problem to have, but it can put a strain on our infrastructure personnel. During those times, maintaining a work-life balance can be a challenge. But again, we all look at, the reward of getting more deals done. And, so at the end of the day, we know it's temporary. The business does this anyway.
Right, right. So your women-owned business enterprise certification opened important doors early on. How has it continued to create opportunity and provide strategic value as you and Keith continue to grow?
Yeah, the inception of Star Hill was really realizing there was a need for a minority lessor that wanted to partner with organizations versus trying to sneak away their business. A lot of large companies, Fortune 500, Fortune 1000, have mandates that they have to do minority spend. So in financing, as a minority lessor, checks that box for them. So, that's kind of was our pivot move for, we could do the deal. And because we're WBE, they get their credits, whether it's mandated. Some cases, there's even tax credits, not so much on the federal level, but in some states, they have, tax benefits. People should reach out to their accountants to inquire more about that because, we cannot give accounting advice. Um, and then, that's really where it comes into, just being a partner to other people.
So that foundation and focus on relationships really connect to your credit philosophy. Let's dive into how you think about credit discipline and risk management across such a wide variety of asset classes. So you've described your approach as asset agnostic earlier, credit conscious. What does that mean in practice and how does it shape your underwriting?
When we do the underwriting, it really looks at the borrow quality ahead of any single, type of equipment or, vertical in the franchise space. We don't specialize in one class. We're not stuck in just transportation, medical, or construction. We start by understanding the customer's business model, cash flow, repayment ability, and, and then look at the asset.
So you financed everything from donut franchises to crematoriums to MRI machines.
Yes.
How do you evaluate risk across such a dramatically different types of borrowers?
Again, because we look at the credit first and we're not bound by the specific asset class or captive framework, we can customize tailored solutions probably a little bit better than most. Whether they need an FMV, an EFA, a track, or even something similar to a traditional loan model, we're able to do that, as we know what their goals are and their credit profile looks like.
So with so much diversity in your portfolio, how do you manage concentration risk while still keeping an eye on growth opportunities?
Again, it really goes back to what the borrower looks like. Obviously in a franchise space, it's very easier to look at the model. We're not going to do, ABC donuts. We're going to stick with a brand name that's probably out there nationally. And I think that really helps to drive, us, being diversified. Because then again, too, the flip side to that is, we do get the deals where it's just traditional equipment finance as well. So really, by being asset agnostic, it's opened up a lot of opportunities for us and the different kinds of people we could have as customers.
So your ability to spot and evaluate those kind of opportunities really depends on reading customer trends. Let's look at how some of those trends are shaping where you're focused heading into 2026. So you focused heavily on tier one quick service restaurants while steering clear of casual dining. What drove that decision?
That really came down to, what quick service in the tier one space. Again, we're talking national brands that everyone's pretty much heard of. They pretty much operate in high transaction volume. They have stable margins and steady cash flows, even when the economy takes a downturn. A lot of there's a lot of brand loyalty out there from a consumer standpoint. And, again, from COVID, fast food really kind of had a resilience that still tends to drive performance today. So that's really, kind of how we look at it from that point.
And how do shifts in consumer behavior like demand for healthier options or the drive-through convenience inform your lending strategy?
I think that's out there. I think these franchises realize, in today's age, people want to eat a little bit healthier. So you see the different types of meal. But again, you also have a lot of quick service, a lot of families are busier now. They're going to stay away from casual sit down restaurants and they're on the go, whether, there's multiple sports or dance or all the activities that kids have today. The, quick serve really does allow them to either eat quickly or eat on the go. And I think we've also looking at that.
I mean, it also reduces overhead too, right? I mean, you don't have all that extra space. You don't have,
It's it's less labor intensive. You don't have the space heaviness. And, again, even though, you hear about, what fast food prices could be going up as well. We're seeing that across the board anyway. Even these, small casual dining places are going up even more because they have a larger overhead. What also helps us kind of decide where we can pivot into is because they're backed, are backed by the actual franchisor. They get the marketing. It's not like they have to put out their own marketing. Maybe locally they will, but from a national standpoint, they have that support from the franchise. And even some of them will even send in a fixer should a store be underperforming. And the amount of data they collect when you're looking at an opportunity and you're looking at the financials, you can see the full spread and how it compares to other stores, whether it's regionally, across the continental US to really help us make good credit decisions.
Is there a lot of market research that goes into putting some of these stores or these quick service restaurants strategically in certain locations based on population and traffic and things like that?
I mean, yes, you do see some regional things, but again, they're also very good, like national brands. Something that's very popular in the South, we may not see in the Northwest, where a different, type of hamburger joint may perform better in Portland than it does in Florida. Just really trying to spread it out. But the research and that is put out, like literally there's like volumes of information to kind of go look at comparison, and again, it breaks it down regionally by brand. So you can really make sure the store or their past, even if they're opening a new store, their past other stores have succeeded and we know where they're going. Again, you're not going to continue like, oh, well, I wasn't a good burger franchise, so now I'm going to just try pizza. At the end of the day, these are entrepreneurial owners and they're either going to make it or not. Sometimes switching the brand isn't, the right move if they're not a good operator.
So let's talk about inflation and cost pressures that can affect different segments in different ways. How are you positioning your portfolio to navigate those challenges?
Again, being asset agnostic allows us to balance exposure pretty well. And, we strategically leaned into the tier one for their stability. And then again, the equipment deals that we do, again, we're using, credit to drive our decisions and how we're dealing with, inflation and economic pressures that are out there. The economy is always going to be shifting. So again, you just have to look at where best to pivot and focus your energies and underwriting on to make sure we can stay successful.
In looking ahead, how do you balance being opportunistic with maintaining the conservative credit discipline that's become a hallmark of your brand?
We've built our reputation on saying yes to the right deals, not every deal. That's kind of been an important, tactic for us to follow. Our partners trust that when we commit, it's because we've done the work and believe in the long-term performance of the borrower and like their assets, so to speak, and what they're going to do. We'll continue to pursue opportunities that fit our credit philosophy and assets that make good economic sense for us. Going into 2026, we're probably going to, again, look at our, proven borrowers, focus on the deepening relationships with, trusted partners in both franchise and in the equipment finance space. Um, you know, but that being said, we should always expect the unexpected. Even though we have a playbook and a good plan going into 26, we have to be prepared to pivot for market changes. Because as we know, in this industry, eventually history will start to repeat itself in an economic trend.
That's great perspective, Hollis. Before we wrap up, what is one piece of advice you'd give other independent lenders trying to stay both resilient and opportunistic in this environment?
It really goes back to, again, your ability to pivot. You have to be willing to look at different assets. I mean, let's look at trucking right now. Nobody really wants to touch trucking right now. But if you're a trucking equipment finance person, you've got to make a move into something else in order to stay successful. And then again, look at your expertise, who you have. Do we need to diversify more? If we only do, FMV leases or dollar out leases, should we be offering something else to people? Having almost I guess, a variety of product offerings. And again, being able to pivot is probably what's most crucial to the success of an independent.
Hollis, that's terrific insight. I really appreciate the perspective you shared today, from the strategic pivots that defined Starhill's growth to your disciplined approach to credit and marketing positioning. It's clear that your success has been built on a mix of agility, experience, and the ability to read the market before others do. For our listeners, I encourage you to follow Star Hill Equipment Finance and connect with Hollis to keep up with their latest initiatives and thought leadership. There's a lot to learn from how her team has navigated some of the most unpredictable cycles in our industry. Hollis, thank you again for joining me on ACS Portfolio Perspective. It's been a pleasure having you on the show. And to our audience, thank you for listening. Be sure to subscribe and catch future episodes as we continue exploring the people, partnerships, and perspectives shaping the equipment finance landscape. Until next time, I'm Andrew Pace. Thanks for tuning in.